Are you entertained yet or not? Feels like it is one of the best months of May we ever had in history. There are some opinions out there that are screaming a market crash. A lot of analysts are asking you to sell tech and focus on value and recovery stocks. Stocks are down one day and up the next day. Between all of this talk about yields, inflation, recovery, growth versus value, Bitcoin, and everything else, volatility is back. What do you do as a long-term investor? Hey guys, Raj here, and welcome to the channel where I talk money, which is hard to come by these days. In this video, I want to share some tips and strategies I've learned and built over time when dealing with a volatile market. There's a lot of noise in the market these days, and it is very easy for the little guys like you and I to get sucked in. Let's talk about ways to manage noise and your portfolio. Inflation is the name of the game these days. Some argue you need to trim high beta tech and stay in value and recovery names. Others say crash is in the making and you need to go defensive. The CNN Fear Gauge Index is flashing fear. Buffett Indicator is flashing a warning for a while now. Apparently, the market is way overvalued compared to the historical trend. The way May is going, it feels like something big is brewing. Does this mean you sell a bit and stay in cash till things settle down? Let's discuss that. 2021 might feel like a bad year for stocks, but we are just 2 percentage points from the all-time highs for the S&P, and NASDAQ is off by 5%, give or take. Given the noise we are hearing, I think the bull market is holding up pretty well. And remember, we came into 2021 with huge gains from prior 2 years. While taking some profits is fine, not staying invested is the biggest mistake you can make as an investor. Let me share some pictures. Here is some information Fidelity put together. Despite market pullbacks and corrections, stocks have risen over time. If you went cash when COVID hit, you missed one of the biggest rallies of our lives. Here's another interesting chart from Franklin Templeton. Despite intra-year volatility, the S&P 500 index had positive year-end total returns 25 out of the last 30 years. Cashing out in anticipation of a crash is irrational. You're trying to time the market, which usually never works. Going back 40 years, if you sold and missed some of the best positive days, it can prove to be pretty costly. Point I'm trying to make here is volatility is part of investing. Ignore the noise and stay invested. After back-to-back years of crazy gains, it's fine for the market to take a breather and consolidate for the next leg up. Does that mean you do nothing and just hang in there and see it through? To be honest, that is not a bad strategy, since any short-term news, price action, or current event is mostly noise, and as a long-term investor, you will be better off just ignoring it. With that said, let me share some tips and strategies I've personally experienced and used and can work for any investor out there. Let's start with some tips. Number 1, always remember market corrections, volatility, and drops is normal when it comes to investing. Indeed, it is considered healthy for the stock market. Number 2, no FOMO and no FOLE. Most investors buy high and sell low. Imagine you chased Tesla when it was trading at $900. FOMO, fear of missing out. How about selling everything during the COVID drop, and then watching the market recover from the sideline. FOL, or fear of losing everything. By the way, I'm still hodling all my Bitcoin and Ethereum. Indeed, I bought some more. Hodler right here. Number 3, ignore the short-term price action. Instead, think long-term. Where do you think a stock will be 5 years, 10 years from now? Focus on accumulating high-quality stocks when they are on sale, like some of the tech names right now. Number 4, your portfolio doesn't need to include every stock out there. If you're starting out, investing in just ETF SPY will take you a long way. Over time, build your portfolio around quality ETFs and stocks. Please don't ding me on this one, but meme stocks should not be part of your long-term portfolio. Have some fun stash on the side to play meme if you want. It's a lottery ticket. Win big, lose big. My stash is in Robinhood. I get YOLO and diamond hands and all that, but it needs to come from your fun stash. Number 5, trying to catch the bottom or time the market is stupid. Jumping in and out does not work either. Instead, try and build your portfolio over time. Think buying dips, investing consistently over time, and dollar cost averaging. Before I jump into strategies, here's a quick question, and let me know in the comments how you would react. What will you do if the market dropped 20% next week? Sell everything and go cash, or buy the dip, or do nothing and just wait it out? Here are some strategies I've used over time. Has worked for me, and don't see a reason why it can't work for any long-term investor out there. Number 1, invest consistently and automate. If you are a new investor, the best approach is to invest a little bit every week, every month, $100, $500, $1,000, whatever works for you. Open a brokerage account and set it up to automatically pull, say, $500 from your checking account every month and invest. If you're not sure where to invest, just drop your dough in SPY. By doing that, you are getting exposure to S&P 500 companies, the best out there. The key here is be consistent and automate it, meaning set it and let your account grow over time. Best approach for new investors. Number 2, buy dips. Some of the best opportunities come when markets fall hard. From the March lows, S&P added almost 55% for 2020. A logical question here is, when do you buy the dip? What if the market falls further? How do we know that a market has hit the bottom? The fact is, we won't. Typically, I put in new money when markets drop 10%, 20%, and 30% from all-time highs. The idea is we won't know where the low is, so you buy a bit at regular intervals. There's no magic formula here, just my buy points. It could be 15%, 20%, 25%, and 30% for you. The point is, buy a bit at regular buy points. Number 3, core versus non-core. Not everyone has the funds to buy dips. How do you deal with that? One way to deal with this is sell positions that what I call are non-core and reallocate the proceeds into core holdings. Core positions are the ones where I'm in for the long haul. Non-core, on the other hand, are in areas which offer short to medium term opportunities. I'll come back to this. Number 4, risk on, risk off. Something else to think about is managing risk. When market feels frothy or parabolic, it might make sense to move money from high-risk securities into low-beta names. Similarly, in an oversold market, you might want to take more risk. These last 2 strategies can apply to a number of different portfolios. For example, growth versus value, or stocks versus bonds, or leveraged versus non-leveraged. I will go risk on or overweight with leverage ETFs when markets are oversold. For example, during COVID, when stocks were completely destroyed, I kept accumulating leverage ETFs. Also, as the market was recovering, work from home trend led to a crazy opportunity in the short term to put money in cloud stocks. This is something I tag as non-core, where I have a short to medium term opportunity to make some money. I'm still into high beta names, but played via ARK Invest ETF, what I consider as core. Talking about ARK Invest, Cathie Wood treats FANG stocks as low risk. When markets turn south, you'll often see her trimming FANG and taking on more risk and buying the dip in her high conviction names like Tesla, Roku, and Teladoc. Number 5, finally rebalance as it makes sense. There will always be some short-term opportunities brewing in specific areas, but overall, you want to have a balanced portfolio. You don't want to be overweight in any one sector like finance, energy, or tech. Don't forget, rebalancing is a taxable event. At the end of the day, even if you did nothing and just auto-invested in SPY consistently for the rest of your life, you will be fine. Hang in there, stay invested, and stay disciplined. Trust me, there are far more better days ahead. Hope this helps. Until next time, peace.